As we move toward U.S. elections in November, we're taking a look at what the policies of the candidates could mean for the economy and for business. Last week, we heard from economist Larry Summers. This week, we're joined by Steve Rattner. He's chairman and CEO of Willett Advisors, which invests the personal and philanthropic assets of Michael Bloomberg. He is our founder and majority shareholder. Welcome back, Steve. Good to have you.
Great to be here, David.
Now, we don't know who the candidates are, first of all. We're still early on. But we have two frontrunners in the present president, Joe Biden, and the once president, maybe future president, Donald Trump. Just taking those examples, what do we think we know about what the economic policies would look like under those two presidents?
Well, these are they have vastly different visions, of course. Joe Biden is a kind of FDR Democrat, lean in. Government can be a positive force in the economy. Let's pass the infrastructure bill. Let's implement the IRA, and so on and so forth. And so I think you'd expect him to do more of the same. I think there's a real question about who's going to control Congress, which may limit his degrees of freedom. The budget deficit is $2 trillion, and I think people are starting to focus on that, which will limit his degrees of freedom. But there's still an enormous amount of implementation that he can and should do of the laws already passed, as well as a lot of stuff that can be done regulatorily. And this is not one I happen to agree with, but for example, the extraordinarily robust antitrust enforcement that's going on at the moment. I think you'll see all that from him. I think Donald Trump has gone even further into the populist world, based on the rhetoric at least, and based on the advice he's getting from people like Bob Lighthizer. And you're going to see a very protectionist, mercantilist economic policy, including things like banning imports of television sets from China, which seems kind of ridiculous. We import all our bicycles from China. We're going to stop having bicycles and so on. So he's got all of that. And I think you will see an absolutely opposite regulatory approach from what you would see from Joe Biden in terms of let 1,000 flowers bloom, let people go do what they want, and let's roll back the regulatory state.
So a lot of the traditional economists might really take issue with some of what Donald Trump is proposing. But what about global Wall Street? Because as you described that, a lot of more government, more regulation on the one hand, less government, less taxes, I would say, less government involvement on the other. A lot of the business community would say, well, the second one sounds better to me.
Sure. Look, there were a lot of people who basically, on Wall Street, who you and I would know, who voted for Trump once or even twice. Basically, look, I don't like the guy, but I like the policies, and they got what they wanted. The TCJA, the Tax Cut and Jobs Act, being the most prominent. But you'll remember a lot of us kind of got this wrong. On election night, when it looked like Trump was going to win, initially the market crashed. Then people said, wait a minute, like 3 o'clock in the morning, they said, oh, wait a minute, the market soared up again, and it kind of took off from there, and then you had COVID and whatnot. This time may be more complicated because Trump's policies are not mainstream Republican orthodoxy. He's often the populist world with all these tariffs, which business hate, with shutting down immigration, which business hates. They need the workers. So I don't know that global Wall Street, and plus all of his anti-democratic authoritarian talk, I think it scares people. And so I'm not sure whether Wall Street will react well to another Trump victory.
What about the protectionist stance? Because he has said 10% tariffs across the board. Robert Lighthizer, you referred to, he's written a book that says we'll keep going, we'll keep increasing until we eliminate the trade deficit. What could that do to the economy, perhaps not just in the United States, but also globally? I mean, we had something called Smoot-Hawley, as I recall, back in 1930.
Yeah, I mean, Smoot-Hawley didn't cause the Depression, it exacerbated it. The Depression and the crash that happened before Smoot-Hawley, people thought Smoot-Hawley was a solution to it, and of course it just made the problem worse. It was like leeching people in the old days, and that's kind of what it is. Look, I don't think there's any debate among serious economists. From a macroeconomic standpoint, trade is good. Therefore, moving against trade is bad in terms of the impact on the overall economy. Whether we go into a crash and a depression, I'm not sure I would predict that, but it's bad. On a micro level, the problem with free trade, so to speak, is that there were jobs lost. The opening of China into the WTO unabashedly, unquestionably caused us manufacturing jobs. But the overall economy was better. Everything you and I bought was cheaper and better because it was made in China. And yeah, we can reverse all that. We can ban television sets and bicycles from China, and the consequences would be not, I don't think, disastrous, but they would be noticeably bad.
You mentioned anti-democratic initiatives, as they can be called, of President Trump. What about the rule of law? That feels a bit abstract. At the same time, how much of our economy is really based on the fact that we sort of know how the legal system works, how the courts will rule in a given case, in a commercial dispute, for example, or when bonds go bad. We know what that is. If that got undermined, what could that do to our economy?
Look, the rule of law is fundamental to the function of a capitalist, free enterprise society. And if you look around the world at countries and you say, the economic development people say, okay, well, what do we need to do to get this country moving again? Rule of law is always like number 1, 2, or 3. It's at the top of every list. So obviously, stepping back from that could have pretty bad consequences. He hasn't really said too much about that yet, so we don't really know. And look, it's uncharted waters for us. We've never had a president or even a candidate seriously say, I'm going to roll back the rule of law. But it would be bad. We all know it would be bad. How bad? I'm not sure I'm ready to predict that yet.
Steve Rattner will stay with us to go through the lay of the investing land in 2024. Past performance is no guarantee of future results. It's true for investments, and it's certainly true for entire years. The overall performance of 2023 was encouraging in many ways, with inflation coming down while inflation-adjusted income went up.
History was not a good guide to 2023. Some things really were different this time around. At least so far, that inflation-unemployment trade-off that people thought would require a severe recession in order to bring inflation down hasn't come to fruition.
The economy exceeding expectations in growth and jobs.
Labour is in a stronger position than it has been for much of the past few decades. Unemployment is very low, the economy is very strong, there's a shortage of labour, the labour market has changed after the pandemic, and so there's a sense that labour is in a stronger position.
And certainly the stock market way outperforming what we expected for the year.
What an incredible year for equities. I was wrong. I predicted, David, that the markets would be down this year because, well, gee, the Fed raised interest rates 525%. Should have had a rough market.
But one way in which 2023 was not at all encouraging was in climate change, giving us the hottest year on record.
What we're seeing now is just repeated examples of natural disasters, climate extremes happening at scales we haven't seen before, in places we haven't seen them occur before. And so we're really in this period of growing natural disaster risk.
And now we're on to 2024. And the need to anticipate how much the trends we saw last year will continue into the new year. Or, for that matter, whether we were reading the signals correctly even last year.
Inflation looks relatively under control, but there's a lot going on underneath the surface, and there are still substantial risks. My gut is still that the market is underestimating the inflation risks in the current situation, and therefore probably overestimating the amount of Fed cutting that is going to take place. But it's a fairly close call.
For his views on the investment terrain in 2024, Steve Rattner of Willett Advisors has stayed with us. Steve created those 2023 charts we showed you as part of the year in review for the New York Times. So great charts. We've borrowed them from you, Steve. But give us a sense of going forward. You had the ones that defined 2023. Let's talk about what it looks like from your point of view in 2024. Let's start with the first one you had, inflation and rates. Right now, there's a lot of higher rates. Inflation seems to be coming down just in the United States as well as around the world.
Inflation has definitely done better than any of us thought. The economy has remained stronger, even in the context of a low unemployment rate and inflation coming down. I think it's important to note, as Larry Summers has done repeatedly on your program, that for all of the celebration, we're not at 2% yet. Wage growth is still running at around 4%. If you assume 1 or even 1.5% productivity, it implies an underlying rate of inflation of around 3, which is what core inflation is roughly running at. So the question is, does it get to 2? I don't believe the Fed is going to raise interest rates again unless something really untoward happens. But I think it would be really hard for Powell to start cutting rates with inflation not yet even at its target. The market obviously has assumed substantial rate cuts this year. Most of the people I know and talk to, including my own colleagues, I think generally we feel that the idea of 6 rate cuts, 125 to 150 basis points of rate cuts this year, seems pretty unrealistic to us. And therefore, you have to raise the question, what's the implication of that for the market, which obviously looks very closely at what the Fed and where rates are in terms of an alternative investment place.
So how does it inform your decisions as someone who oversees investment of a lot of money about equities? Because earlier, a year or more ago, you were on this program saying you're not so excited about equities because the rates are high, they're going to go higher, and that's going to really cut into the value of equities, given the discount rate. At this point, do you feel better about equities, given the fact that you think probably it's not going to go a lot higher?
Well, first, you were nice enough not to get too in my face about last year, but I'm going to do a mea culpa and say I don't think almost anybody I know in the investing business expected what happened. Obviously, you had the Magnificent Seven, but even aside from that, the S&P and the markets performed much better in light of high. Those rates right now are kind of where they were a year ago, but the market is, depending on how you want to measure it, anywhere from 15 to 25 to 40% higher than it was. So that's kind of an odd development, frankly, relative to history. Anyway, looking ahead, I think we feel that rates are not going to go up anymore. You did have at the end of the year a nice surge in things like biotech stocks that have been hit hard by rates. So we're cautiously optimistic, or at least not scared, about the market this year because we don't see the Fed raising rates again. Corporate profits are projected to be up a little bit, not a huge amount. The S&P multiple is still high, but it all seems kind of manageable in the U.S.
What about growth in the U.S. for the moment? Because a year ago, many economists were predicting a recession. Didn't have it last year. Not clear at all we're going to have it even in 2024 at this point. What are you looking at for growth for the United States going forward?
I have no more wisdom than any economist does. I think the consensus is for a small amount of growth, something less than 1%. The problem with predicting recessions, it's a little bit like the old Roadrunner cartoon. You're running around, suddenly you look down and there's nothing below you. If you look back, I think you would find that more often than not, people did not say we were in a recession until we were well into the recession. And so there are signs of the economy starting to weaken a little bit. The jobs market is weakening a little bit. Retail sales are weakening on an inflation-adjusted basis a little bit. You do see signs of stresses and strains, savings rates, credit card usage, subprime, auto delinquencies, things like that. I'm not predicting a recession. I'm just saying that we're close enough to the edge that it could easily tip either way, in my opinion.
One of the things that you focused on, including in your charts for the New York Times, were on wages, and particularly what happened with labor unions, which was a big story in 2023. Right now, last time I checked, real wages are actually going up somewhat, slightly in the United States, as opposed to going down. That's, on the one hand, bad for margins for corporations. On the other hand, good for consumers because they have more money to spend. As you look into 2024 and beyond, what do you think is going to happen with wages?
Yeah, look, there's no question that part of why the economy was so strong in 2023 relative to what people expected was because there was more purchasing power. Inflation came down a lot and wage growth went up a little bit. And secondly, you have this very large budget deficit, $2 trillion. So the government's doing its part. In terms of wages, I think you're going to see continuing upward pressure on wages. I don't see a wage price explosion. I do think that expectations have been managed well by the Fed's rate increases and other things. And so you don't see, as economists would say, an unanchoring of inflationary expectations. They seem to be under control. So I think you're going to continue to see wage growth in the 4.5%, maybe 5% range. And then, therefore, you're going to continue to see inflation maybe in the 3% range. And then the question will be, what does the Fed do about it? I believe the Fed's summary of economic projections would have inflation pretty close to 2 by the end of next year. I'm not 100% sure we're going to get there. And as I said, I don't see them raising rates. I just see them delaying rate cuts if we don't get there.
Steve, one of the things you focus on is immigration. You do it in the charts for the year end of 2023. You've written otherwise for the New York Times about immigration. Immigration is an issue, certainly politically. We have a lot of people coming across the border. We have northern cities, including run by Democratic mayors, really upset about it. At the same time, we need a certain number of workers coming in. Give us your views on where we're going with immigration in this country.
Well, I got into this, David, because I was looking at China, and China's population is projected to fall from 1.4 billion to 770 million by the end of the century because of their fertility rate and the fact that they have emigration. 300,000 Chinese a year leave and nobody comes because it's a monocultural society. We take in 1 million a year legally, and if you just want to maintain our population, given our fertility rate, you have to take in 4 million a year, or else our population will start to decline. So we need these people. We have a 3.7% unemployment rate. They're not going to take away American jobs, but it is the most divisive political issue. And frankly, President Biden didn't say open borders, but he conveyed a sense that we wanted people to come here back from the first day of his inauguration. And the result is you have 3 million people a year now crossing the southern border and going through our crazy convoluted system. And the Republicans, therefore, have no political incentive really to solve this problem. Biden owns it. The country, even including Democrats, are very unhappy with our immigration policy. And there could be a deal in Congress. I think they're going to announce something this week, but I'm not that optimistic it's going to get passed.
And finally, Steve, because you take a longer view as an investor, are we just going to in a period where investors have to have lower expectations? We had an extraordinary period of essentially, I will call it free money. And that benefited us in all sorts of ways, including investors, I would say. There's a lot of talk right now that we just have to lower our expectations about what returns, regular expected returns will be going forward. Do you share that view?
Sure, and I share it for the reason you said, but I also share it, and I don't have these numbers in my head, by the following point. If you look back at what the market did in a 5-year period or a 10-year period starting in each year, you will find that in years where the P/E ratio was as elevated as it is today, the market's performance in the ensuing 5 and 10 years was pretty modest. It was positive, but it was sort of low, mid-single digits is my recollection. And so a lot of this is where you start from, and we're starting from a very high level. And so, sure, I think our expectations are fairly muted. And you and I have had a conversation, I think, last time. We're doing a lot more in credit, because if you can make 10% in very senior, well-secured credit versus what we think the market's going to do, we are still shifting our dollars in that direction.
Okay, thank you so much. Always great to have you with us. That's Steve Rattner of Willett Advisors.